Will the Fed increase interest rates? And what does that mean for you in the stock market? So some of the key variables that we need to look at to be able to determine if the Fed should consider or will consider interest rate hikes are money supply growth, inflation, and the backdrop of the economic situation. So let's start off with a really important one, money supply growth. So currently, on a year-over-year basis, money supply is growing at negative 1.7%. What this tells us is that there is not, on a year-over-year basis, inflationary pressure building in the system. So that is a downward force on inflation, and that's a good thing for getting inflation in check. However, on a quarter-over-quarter basis, inflation has been rising and has also been rising from a money supply growth perspective as well. So those are kind of some mixed signals there, and that's also playing out on the inflation front. Currently, core inflation is running at 3.8%, and headline is following suit at 3.5%. Although those figures are much lower than the 2022 highs, they are still much higher than the last 20 to 30 years on average, and is enough for the Fed to be very cautious about lowering interest rates so the economy is not overstimulated. Then moving ahead to the economic situation. Currently, unemployment is ranging around that upper 3 range, but if we take a look at continued claims, that is up 35% from the economic cycle floor in June of 2022. That paints a really important picture. All the way back to the 60s, if you take a look at the entire sample of data, anytime that continued claims has risen by that amount, that basically tells us that a recession is imminent because any kind of systemic economic shock, whether it's 1990 with the Gulf War or 2020 with COVID, if that continued claims number starts going up over 15%, then the economy is very weak, and any kind of small little shock can take it over the system and trigger a recession out of that. So we are at an elevated risk over the next year for having a recession. I think that's also factoring into Jerome Powell's thinking in the Fed as well, in terms of being very cautious and conservative about adding any more systemic risk or pressure to the system. Next, we move ahead to a couple of non-traditional things that are to be considered from a macro perspective, and that is major cycles. So in history, every 84 and even 248 years kickstarts a major conflict period. This is a period of time when there are major domestic and international conflicts that play out. It's important to know that we are at the 83rd out of the 84th year for the 84-year cycle, and the 248 out of 248 year for the major cycle for that one as well. That's important to know because that could bring some wild card situations to the financial market, even more so than in 2008. So that's something that we got to take a look at, especially as we go over into 2025 and 2026. Next, we're going to move ahead to the market discount cycle. So the market discount cycle occurs every 3 to 4 years, and it basically is an alignment of both fiscal and monetary policy in conjunction with the political cycle. So this is when either rising inflationary pressure or rising unemployment rates can be discounted in the market. Last time we saw that was in 2022, was the allowing coordination of both the fiscal, the monetary policy, and also the political cycle to have the expensing of that inflation issue by raising rates and cutting fiscal spending from all-time highs during the 2020 stimulus to be able to rein that in. So we're at year 2, and it's a 3 to 4 year cycle. So this is something that we got to look at more so down the road in 2025, 2026. But in 2024, that actually paints that next picture a very good story. And that is the monetary policy and the fiscal policy that is coming down. So the monetary policy currently that the Fed is considering is raising rates. Although raising 25 basis points in theory shouldn't really cause any kind of effects, it's mostly optic, and most of those effects, even incremental like that, would probably play out more so 12 to 18 months down the road. It does cause a spook to the system and would definitely cause the markets to go down. So because this is a presidential election cycle, and we're moving into the latter portion of 2024. It's unlikely that we're going to see rate hikes, especially if inflation is keeping where it's at and the macro and geopolitical background is very suspect at the moment. So fiscal policy as well, we have a ton of government spending, and that's going to keep the economy riding right along unless a major shock comes in, which would in due course cause more government spending to happen, which would be another positive situation for the stock market as well. And finally, let's talk about the S&P 500 valuation, the final of the 8 different factors to take a look at. And that is the market is currently averaging a 28.5 PDE ratio on estimate. And that's about 7 points above the 21.5 average from 1990 on. Back in 2022, the market was very overvalued, around 30. Market dropped 19% on the S&P 500, and some tech stocks got hammered 30, 40, 50, 60%. And the aggregate of the market goes down at about 21, settles there, and rallies in 2023 and 2024, coming back to new PDE highs there. So that's something to consider as well. When that market discount cycle year 3, year 4 happens, when there's that alignment of fiscal and monetary pressures with the political cycle, that means that stocks at that point will definitely increase significant pressure on the downward side and lose a lot of value there, especially if we have some inflation building into the system due to excess spending that comes around due to issues that arise from the major cycles later on. Well, that's all for now. Thanks for watching. Make sure to subscribe to the channel, and I'll see you on the next video.